In this video, we are going to talk about taxes. Yep, I said it. Possibly the most boring subject there is, but the truth is nobody loves to pay taxes, and just about everybody has to. Or do they?
Oh?
Now, I'm not a CPA. In fact, I hire my own, so make sure that you talk to your own tax advisor to make sure that these strategies will work for you. I'm going to talk about the 3 lesser known strategies I personally use to help take my tax burden down to 0. Somehow, the third strategy never gets talked about. It's probably the one that almost everyone can and should do. And the IRS wants you to take advantage. So hang in to the end to hear that golden nugget. Now let's get going. Just last year, this Gallup poll showed that 60% of Americans felt that their federal income taxes were too high, while 46% regarded their income taxes as fair. And if you're anything like me, you're wondering how exactly that math adds up. Kind of makes you question the accuracy of the rest of the poll. But truth is that 60% of Americans do feel that they pay too much in taxes, and that corporations and the wealthy get away with not paying enough or their fair share. Now, whether you agree or not, chances are 6 out of 10 people watching this video do believe they're paying too much in taxes, while the other 4 out of 10 people probably fell asleep and have no idea what's going on. In this video, I'm going to highlight my less known tax strategies for reducing your tax bill down to 0. I personally used all 3 of these strategies in the past year, which allowed me to go from owing $5,000 to getting a $4,000 refund. That's a $9,000 swing, and I'm pretty sure just about everyone watching this video can use an extra $9,000. Now, we have to start with a basic understanding of the tax code. Here in America, we have a progressive tax code, which means that the more money you make, the higher the percentage of taxes you pay. But that only applies to earned income, meaning the money you make at your job. So you have to look at it from the other side also. The less earned income you make, the less you'll pay in taxes. There it is. Quit your job, make no money, and you'll pay no taxes. Thanks for watching. I'm out.
Huh?
Now, while I'm joking about quitting your job, I'm actually serious about reducing your earned income on paper. Now, let's use an example. A single person making $100,000 a year is going to pay about $15,000 in taxes, give or take. However, if that same person puts $5,000 into a tax-advantaged account, like a 401k or a traditional IRA, the IRS is going to tax you as if that person only made $95,000 that year, which will drop your tax burden down from $15,000 to $12,500 about. So the more money you put in these type of accounts, the less money you will make on paper that year. Now, you will have to pay taxes on that money when you pull it out during the retirement years, so keep that in mind. Now, most of you already know this stuff already, so I'm not going to spend a whole lot of time here, but one of the accounts that's drastically underused and usually misunderstood is the health savings account, or HSA. A health savings account is simply an account that works exactly like your 401k, in that the money that you put in from your paycheck reduces the amount of taxes you'll pay in that year. But the money that you then take out of the account to use towards medical expenses is tax-free, right? Now, again, most people know this, but that means you get a tax deduction the year you put the money in, and if you use it for medical purposes, you get a tax-free withdrawal. It's tax-free on both sides. So not a lot of accounts do that. In fact, there's almost none. But here's what people usually make the mistake. Most people, they go to their doctor, they pay their bills, they buy their prescriptions, and then they use the money from their HSA in that same year to pay for it. That's not the best use of this account. Instead of taking money out of the account in the same year, my wife and I document our expenses and we plan to use them in the future. And instead of taking our money out of our HSA, we allow the funds in the HSA to continue to grow tax-free. We invest that money into something like an index fund that tracks the S&P 500. See, there's nothing that says you have to use the money in the same year as the actual medical expenses. So instead of depleting your account every year, if you contribute the maximum contribution, which in 2024 is about $8,300 for a family, invest that money into something like an S&P 500 index for the next 25 or 30 years, that account could be worth as much as $1.4 million and will have given you tax breaks every year that you put the money in, while now having 25 to 30 years worth of expenses that will offset any money that you pull out. And let's not forget, as we get older, our medical expenses tend to go up. So I know that sounded complicated, but let's make it really simple to understand. You get a tax break when you put money in, you got the growth that you didn't have to pay taxes on year after year, and as long as you have medical expenses to offset the money you pull out, you get tax-free withdrawals. Now, let's move on to tip number 2. This one isn't going to be able to be utilized by everyone, but for those who can or are willing to learn, rental property. Real estate has one of the best tax features of any investment. This is truthfully just one of the areas where people get angry because of the unfair advantage real estate seems to give to the wealthy. But the truth is, the tax code is written in such a way to benefit certain activities, such as providing housing. The government is terrible at providing housing. People love the idea of affordable housing, but they hate the idea of it being on their block. So the IRS is willing to give real estate investors extra tax incentive to take over that burden for them. So how does it work? I'll use one of our properties as an example. We bought a property for $318,000. We have a tenant in that property that pays us a little over $2,000 a month. Now our expenses on the property generally equate to about $1,600 a month, leaving us with $400 a month in net profit. Now, without going too deep, at the end of the year, we'll make about $4,800, and that should be taxed because it's gains, it's actual income. However, the IRS knows that about every part of that property will have to be replaced over a 30-year period. We'll eventually have to repaint the walls, redo the flooring, and all the other maintenance stuff that comes along with it. And the IRS understands this. So they have written into the tax law the ability for us to take what's called depreciation. That basically gives us the ability to reduce the value of the property based on our purchase price over the next 27 and a half years. For us, that will mean about an $800 a month reduction from our monthly income. So instead of the IRS seeing that we made $4,800, it actually looks like we lost $400 a month for a negative of $4,800. And remember, if you don't make money, you don't pay taxes. This truly is an unbelievable advantage to owning real estate. And my personal belief is that everyone with the means should at least partner with someone else to buy real estate. And it's what I do with some of the investors that I work with. For those that work in the field of real estate or have a stay-at-home spouse, they can take advantage of even larger depreciation strategies on their properties. But it's too detailed for this video, so I'm going to keep it basic. What I will leave you with is that this is one of the reasons that real estate has created the most millionaires when stacked up to almost any other investment. And while some people think that you need to be rich to purchase real estate, it's simply not true. Watch some of my other videos for tips on that. Now, this last strategy is almost never understood or ever even talked about. And this is one that separates the rich from the poor. Poor people tend to have hobbies. Rich people have businesses. Here's an example. If you love to play video games when you get home because, they're video games, that's a hobby, right? Well, what if you documented your video game playing and posted videos online like I'm doing here? And what if you started to produce a little income? Well, suddenly that hobby starts to look like a business. And what does that hobby require? Well, you need space to play, video games, internet, gaming chair, electricity. All the things you were going to buy anyway now are tax deductible business expenses. And business expenses means a reduction in the money that you bring in. My wife loves to look for items on bulk trash pickup day that people leave behind in their trash. She'll fix it up and then resell it. And what does that require? Suddenly we need storage in our garage, which is constantly full of junk, mileage, gas, internet, to use her phone just to reach out to customers. Again, all of those things become business expenses. And these are expenses we were already paying for anyway. So now a portion of them is tax deductible to our income. Just imagine how many things you do on a daily basis that could be considered a business if you just changed a few things around and tried to sell a few items. That gives you the ability to write off a lot more of your regular expenses instead of paying with them with after-tax dollars. Now, of course, you need to talk to an accountant about the specifics and see if those are things that would work for you. But by shifting your understanding of the tax code, you can reduce your taxes and make some money at the same time. Maybe you can't do all of the strategies I suggested, but it's not an all or none. Every strategy I detailed can dramatically reduce your taxes. Maybe you can't buy a rental property next year, But by partnering with the right person and saving a little more in taxes this year, maybe you can in the next 3 years. That'll be time well spent. I hope you found some great value. So do me a favor, like and subscribe so I can get this video and others like it out to more people, and my wife will stop making fun of me for sitting in my basement talking to myself. Thanks, and I'll see you on the next one.